Think of the stock market like a giant online store. But instead of clothes or electronics, you buy and sell pieces of companies. These pieces are called stocks or shares. When you buy a share, you become a part owner of that company. The stock market is where buyers and sellers come together to trade these shares. It's a place where companies can raise money to grow their businesses. And it's a place where investors can potentially earn profits by buying and selling shares. The stock market is an essential part of the global economy. It allows businesses to access capital and investors to participate in the growth of companies. Whether you're a seasoned investor or just starting, understanding the basics is crucial for making informed financial decisions. Imagine you want to start a lemonade stand. You need money for lemons, sugar and cups. You could ask your friends and family to invest, promising them a share of your profits. That's similar to how the stock market works. Companies need money to grow, so they issue shares, which are like tiny pieces of ownership in the company. Investors buy these shares, providing the company with capital. In return, investors hope to profit from the company's success. The price of a share goes up when more people want to buy it than sell it. Conversely, the price goes down when more people want to sell it than buy it. This constant buying and selling determine the share price at any given time. Imagine you want to know how healthy a person is. You might check their temperature or heart rate. Similarly, the Sensex tells us the overall health of the Indian stock market. The Sensex, short for Sensitivity Index, is like a benchmark that tracks the performance of 30 large, well-established companies listed on the Bombay Stock Exchange. These companies represent various sectors of the Indian economy. When the Sensex goes up, it generally means that investors are optimistic about the Indian economy. When it goes down, it suggests pessimism. By following the Sensex, investors can gauge the overall sentiment and direction of the market. Think about your favorite clothing brand or restaurant chain. Did you know that you could actually own a tiny piece of those companies? That's what buying shares allows you to do. A share represents a unit of ownership in a company. When you buy shares, you become a shareholder, also known as a stockholder. As a shareholder, you have certain rights such as voting on company decisions and receiving dividends. Companies issue shares to raise capital for various purposes such as expansion, research and development, or paying off debt. By buying shares, investors provide companies with the funds they need to grow and innovate. Section 5, real-world examples, from samosas to smartphones. Let's say you love samosas from a particular shop. You believe they make the best samosas in town. Now imagine that shop decides to expand and open more branches. They need money to do so. The shop can choose to issue shares to the public. This means anyone who believes in the shop's potential can buy a share and become a part owner. If the shop does well, the value of its shares goes up and the shareholders profit. Similarly, if you believe in the future of a smartphone company, you can buy its shares. If the company releases a successful new phone and its profits soar, the value of your shares will likely increase. Section 6. Why understanding the stock market matters growing your wealth. You might be wondering, why should I care about the stock market? Well, understanding the stock market can be a powerful tool for growing your wealth over the long term. Investing in the stock market allows you to participate in the growth of companies and the overall economy. While there are risks involved, historically, the stock market has provided higher returns than traditional savings accounts or fixed deposits. By investing wisely and patiently, you can potentially build a sizable nest egg for your future. However, it's essential to remember that investing in the stock market involves risks, and it's crucial to do your research and invest only what you can afford to lose. Section 7, Risks and Rewards, Navigating the Stock Market Roller Coaster. The stock market can be like a roller coaster with its ups and downs. While it offers the potential for high returns, it's essential to understand the risks involved. Stock prices can fluctuate due to various factors, such as economic conditions, company performance, or even global events. It's crucial to diversify your investments, meaning not putting all your eggs in one basket. Investing in different companies, sectors, and asset classes can help mitigate risks. Additionally, it's essential to have a long-term perspective and not panic sell during market downturns. Section 8. Getting started, taking the first steps into the stock market. Ready to dip your toes into the stock market? Here are a few simple steps to get you started. First, educate yourself. Learn the basics of investing, different investment strategies, and risk management. Second, open a DMAT account. A DMAT account is like a bank account for your shares. You'll need to open one with a stockbroker. Third, start small. Begin with a small investment amount that you're comfortable with. You can gradually increase your investments as you gain experience. Remember, investing in the stock market is a marathon, not a sprint. It's crucial to have patience, do your research, and seek professional advice when needed. Section 9. The power of long-term investing. Patience pays off. Investing in the stock market is not about getting rich quick, it's about building wealth gradually over the long term. Like planting a tree, it takes time for your investments to grow and bear fruit. By investing consistently and holding on to your investments for the long haul, you can benefit from the power of compounding. Compounding is like earning interest on your interest, which can significantly amplify your returns over time. Remember, patience is key in the stock market. By staying invested and riding out market fluctuations, you increase your chances of achieving your financial goals.